The RBI lifts regulatory curbs on Kotak Bank after 10 months. The bank is now allowed to onboard customers online and issue fresh credit cards. The stock is higher by nearly 2%.
Bharat Forge slips after a big miss on the revenues in the third quarter. Chairman and Managing Director Mr. Baba Kalyani tells CNBC TV 18 that execution was a miss in the third quarter and that issues with the international subsidiary will be resolved in the next couple of quarters.
Jubilant Food rallies over 6% after reporting third quarter numbers. Brokerages, Citi as well as Morgan Stanley issue bullish calls as operational performance continues to improve.
A strong third quarter coming in from Muthoot Finance drives the stock higher. The stock is up close to 6% as the gold loan growth remains strong. The management tells CNBC TV 18 that the net interest margins will remain between 11 to 11.5% backed.
Lupin rallies over 4% after a better than expected third quarter number. The management tells CNBC TV 18 that they expect US sales to see an average sales of $250 million going ahead. Margin is expected to be between 22.5% to 23.5% in FY26.
Hello and welcome to Chartbusters. You're tuning in to the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Vinny. Well, Vinny, some green on the screen. Yesterday at around 10:30 a.m. the markets were down. By the time we wound up, well, the markets had pulled back considerably. And today we have our work sorted out because the markets are higher.
Absolutely, markets are higher, and all those sectors yesterday which were seeing a very sharp fall, whether you look at real estate, pharma, all of them are coming back, except for Natco Pharma today because of that very weak set of numbers that they reported. Other pharma companies like Granules, Mankind Pharma, Abbott, all of them are holding on to very
well,
good
that's
gains.
right. And the commentary that came in overnight as well was that if there are reciprocal tariffs, then maybe autos and pharma could have some kind of concession. So I guess that's another hope point that's playing out. But let's get to our first management. We have Electronics Mart. Well, the third quarter revenue was a little below the guided levels. Margins as well, a little bit under pressure for the past two quarters. To understand what's the way ahead, Mr. Prem Chand, the CFO of the company, joins us on the show. Hi, sir. Good morning and good to see you, Ben. Well, if I look at your 10-month performance, you know, the growth that you've achieved is close to around 10% or thereabouts. You were guiding for around 15% earlier. So do you end this year closer to that mark? Point number one. And also margins have been a little bit under pressure. I recall you saying that, you know, that you'll be able to improve margins from these levels. Is that on the cards?
Good morning and thank you very much for having me on your show. The first question is about the top line growth, which
Yes.
we were guiding around 15%. Having seen the last two quarters' performance, so the way the markets were operating, it is little adverse. As a result, I think we have to revise that targeted 15% growth to 12% year on year.
Okay. So
And coming to the margins.
So you'll grow, sir, by 12% this year, but on that lower base for the following year, what kind of growth can you deliver? And also give us the margin outlook, both for this year and next year.
Yeah. And next year, definitely, because the base is adjusted. So as a result, I think we are quite optimistic that next year it would be 15% year on year. And it is quite possible because if you look at the markets also, like this year in the investors presentation also, we have clearly shown how the clusters are currently operating. Like Hyderabad as a cluster has a negative SSG, whereas the other clusters have been shown decent improvement and in terms of the triple SG. So those are actually out of the total stores which we have been operating as of now. About 25% stores are still, they're yet to mature. So they are either less than 15 years old or very new in the market. So these stores are going to perform. I think they start generating adequate throughput in the upcoming quarters. Coming to the margins, what happened this year, there was a little competition in the third quarter. As a result, we had to pass on a lot of cashback offers to customers. So that will obviously eat away our gross margins. And the corrective measures have been taken up to mitigate the what are the damage that might cause due to this heavy cashback offers to the customers. And second thing is the product mix. So air conditioner is a category which is actually the important product that is supposed to generate the maximum gross margins among among the categories. So that is also picking up. Since 1st February, we could see decent growth from air conditioners because temperatures are rising in the clusters where we have. Yeah. And next year, for sure, we are going to have 15% line growth as well as
margins.
Improved margins. Like current year, we might end up at 2.5% PAT margin, whereas next year it will definitely improve about 2.8%.
So, but I want to know the EBITDA margin number as well. Currently, it's at around 5%, right? 5.2% during this quarter, 9-month period at 6.4%. For the end of FY25, what would be your margins, EBITDA margins? And next year, will you come back to that 7% range that you were in, 7-8% range for EBITDA margins?
This year, it will. We might end up at 6.5 for the year. But next year, definitely there will be about 30 pips improvement. That is, we are expecting.
Okay. Now, you did touch upon that SSSG growth, which has seen a decline this time, specifically mainly due to the Hyderabad performance being lackluster. So could you just give us an outlook in terms of different clusters? What is the growth in Q4 over there? And also in terms of expansion, right? You have been aggressively expanding your store addition plans, which is exceeding your guidance. So how are these newly added stores picking up in terms of pace, and what is the break-even time for this?
In the last couple of quarters, we focused more on tier 3 and 4 cities. So where store opening is not very difficult as compared to the metros and other cities, tier 1 cities. So that's the reason why we have exceeded the guidance, whatever we are given at the beginning of the year. And by end of this financial year, we will end up at 200 stores count across all these clusters, out of which about 5 stores which are in pipeline in NCR. And these stores were ready in all respects, but due to pollution restrictions on and off, so the store launch got delayed. And hopefully, I think in this month or early next month, so we will be launching another 5 to 6 stores in NCR. Then another 5 stores will be added in the South cluster. So all put together, we will take the store count to 200. But next year, it will not be so aggressive as this year. So this year, we are ending up adding more than 40 stores in the year. Whereas next year, our new store addition will be confined to 30. So, and focus will be in NCR mostly. Like NCR will be about 6-7 stores, and the remaining stores will be added in South cluster.
Got it. Okay, all right. Just to reconfirm, this year 12% growth, followed by 15% growth for the next year. This year PAT margins of 2.5%, next year 2.8%. Is that correct?
Yes, that's what we are having.
Have a good one, sir. Thanks a lot for joining in. The stock has been under pressure in line with the broader markets as well. I think it's corrected substantially from the recent peak, but for the time being, the management is optimistic on prospects going ahead with regard to addition growth as well as on profitability. Now, just keep an eye out on the screen because the Nifty has got to 23,200 and the options data was suggesting that that level will get protected. So now those bears will get a little bit cautious because we got past that level. So very, very important mark is where we are at. The bulls will want to drive home the advantage and trade above this mark while the bears will like to fight back. So keep an eye out on that. For the timing, let's get you some ideas of profit from Money Control Pro. Jitendra Gupta joins us to fill us in with the stock that he wants to educate us about. Jitendra, please go ahead.
Bharat Electronics, which is a leading defense player, could be a good bet considering a strong order pipeline, improving execution and robust earnings growth. Stock was recently inducted into Nifty 50 index. BEL thereafter has corrected from its peak of rupees 340 to currently at about 277. It is now trading at an attractive level, discounting about 29 times its FY27 estimated earnings. In Q3 FY25, the company delivered an impressive financial performance driven by growth in defense and electronics. Revenue during the quarter surged by almost 39% on a year-on-year basis. of course led by strong execution. Similarly, EBITDA grew by 37% and the margins actually expanded during the quarter. Net profit also jumped from 52% on a year-on-year basis. Going ahead, I think BEL would maintain a revenue growth of, it has a target of achieving 15% growth in revenue, with EBITDA margins projected to be around 23 to 25% for the FY25. Its robust order book now, it has an order book of close to 71,000 crore, which is 3.5 times its annual revenue. With a strong order pipeline and increasing defense spending, BEL expected to close FY25 with a rupees 25,000 crore inflows, mainly in Q4. Overall, it's a compelling story supported by strong orders in hand, improving execution, higher earnings visibility, and of course reasonable valuations.
Okay, thank you so much for that, Jitendra. But on that note, we're going to slip into a very short break. And on the other side, we do have the management of Suven Pharma, who's joining with us to discuss the outlook for the company going forward, as well as talk about their Q3 numbers. Welcome back and thanks for staying tuned into Chartbusters on CNBC TV 18. Now let's move on and talk about Suven Pharma. They've delivered a very strong set of numbers in Q3. Revenue growth of around 40% this time on a year-on-year basis. Margins at 38%. What is the outlook of the company going forward? What is the strategy of the company? We have Vivek Sharma, Executive Chairman of Suven Pharmaceuticals, joining in with us to talk about the growth for the company going forward. Thank you so much, Vivek, for joining in with us. And, let's start by talking about the strong growth that the company has seen. 40% growth this time, margins at around 38%. Overall, you have a target of reaching that $1 billion revenue by FY30. So this accelerated growth that we're seeing during this quarter, is that going to be continuing for the company? What is going to drive this growth going forward?
Good. Well, first of all, thanks for having me. We had a great quarter. We shared the results yesterday with all of you. Our vision is to become a $1 billion company by 2030, and we are committed to that vision. Now, CDMO and pharma is a little bit of a lumpy business, so as you know, because pharma companies, as they buy based on their demands and all that. So yes, we are committed to an accelerated growth. We have a very detailed plan to accomplish our vision of $1 billion by 2030. And we are focused on making sure that our growth drivers as a tech-driven CDMO CDMO with the focus on ADC, oligo, as well as chemistry, our API plus business, as well as our specialty chemical business continues to grow and then continues to build relationship with customers that are longer lasting and then deliver the results that we have for the $1 billion aspiration.
Right. So then the strong growth will continue is what you're highlighting, right? That we're seeing during this time is something that has to sustain for you to achieve this also.
That's exactly right. That's how we become from where we are to $1 billion company, right? So we have to continue to grow. And growth is a factor of multiple things. So we've been investing in capabilities. We have, as you know, we have added to tech-driven acquisitions in the last 6 months with Sapala in India, as well as with NJ Bio and ADC. And those are areas where we are looking to accelerate growth, build better relationship with customers, and then provide them more tech-driven and forward-looking services. And as you know, last year, there was about 50 or so US FDA approvals for new drugs. 2 of them were oligo drugs. There's a lot of investment happening in the antibody drug conjugate space. And we are excited with the platform that we have, with the existing capabilities, as well as the New Jersey-based NJ Bio now coming in, that we can offer more global services, more end-to-end services in some of these spaces to our customers that allow us to really accomplish our $1 billion vision by 2030.
Okay, specifically on the CDMO business, this time we're seeing that 101% growth. And you also highlighted that you're seeing increase in terms of the RFQs or inquiries, that is known in simpler terms. How much of that has actually converted to clients? And, will this strong growth in CDMO also continue? You did say the ADC side is doing well, but what is the outlook specifically in terms of growth for CDMO?
So yeah, conversion always takes time. I mean, RFP is the first step, right? So if you have RFPs, then conversion will also happen. Conversion is a factor that depends on a lot of different things. So I can tell you, I think, few things. If you look at the indicators we shared yesterday, we have 15 phase 3 projects that are going on right now. That's a very strong, healthy sign of our future commitment as to how we think that we can accomplish the targets, right? And these are products that we are working with that will start getting commercialized, at some point later this year and over the next few years, right? So that's a big projection that we have. And our goal is to build a strong pipeline of phase 2s and phase 3s while we have early stage work. So the healthier the pipeline we have of these relationships and these products, the better our future pipeline will be. So in my view, the RFPs are an early indication that you have the relationship you are building, and then you take those RFPs and convert them. And the quality of RFP means we want to get more of them, phase 2 and phase 3 get converted. With the ADC investment, what we have done is, that we are one of the very unique providers. We had 2 commercial ADCs that we were providing from our Hyderabad site. Now with the acquisition of NJ Bio, we have a front end as well as early stage capabilities. NJ Bio is one of the world's best known CDRO for ADCs. They've been awarded at the best price for the best CR for the ADCs out of New Jersey. We got about 100 plus scientists, phenomenal number of projects. And unfortunately, they did not have commercial capabilities. So they were losing some of those clients to the competition. Now with our existing capability, we can offer more end-to-end services to those, right? So we have a more end-to-end footprint as well as front-end and world-renowned scientists in ADCs. That gives us a lot of confidence that we can accelerate the growth. You use the word acceleration. That's what been talking about, and these are the drivers for us to really accelerate. Also, just FYI, we have added significant investment in commercial capabilities in the West, so which was not a thing that we had done in the past. Today we have 6 BDs sitting in North America, we have a BD sitting in Japan, we have hiring people in Europe that will allow us to really create that front end momentum and create the brand and connect better with customers.
Okay. What we also want to know is margins, right? Now, with all these acquisitions, how do you see your margins shaping up in the next few years? What are we watching out for there? This 38-40% range, is that something that is maintainable and sustainable?
I think our guidance has been mid-30s margin, and that we will strive to really make sure that we remain in top quartile margins in the industry. We're very proud of what we have accomplished. There's always price pressure, cost pressure, I think, from every angle, but we have to be efficient in our processes, in our resources, in the optimization of our assets to make sure that we deliver the best quartile margin to our investors.
Okay. And sir, just a last quick one. Any more acquisitions in the pipeline? You made a lot of acquisitions in the last 4 years. Any more that we are watching out for now?
Yeah, so we are always looking, as we said, we want to be a tech-driven CDMO. And in that aspect, while we are putting some capital into the existing plants to add some more capabilities, we are always on the lookout for the right acquisition that will allow us to really accomplish our vision of $1 billion by 2030.
Okay, so, thank you so much for joining with us on the show and giving us the outlook of the company going forward. But on that note, we're going to slip into a very short break. Don't go anywhere. On the other side, we'll get you more updates.
Welcome back. Well, the markets are holding closer to around the 23,200 odd mark. You wanted to get past that mark. The broader markets are participating better because they got hit harder. And a few stocks you should look at. Premier Energies, that one that just listed. The stock has seen a sharp correction from the peak. ICICI Securities, they have come out with a note and they have an aggressive target price out there. The stock is up 4%. Welspun Corp has been relatively outperforming the market. That continues as we speak. And Vodafone Idea, the stock had started off in the red. But Vodafone Idea as well has moved to the high point of the day. So there are various stocks that did pull back, but they as well are moving back up. But that's it from Vinny and myself on Chartbusters. You stay with us. Trading Hour comes up next.